What's up, iguanas? Iggy here from the Investing Iguana. In today's video, I'm going to share with you 5 stable investment options available right here in Singapore. Whether you're just starting to build your nest egg or looking to diversify, these choices can help you reach your money goals in a steady, low-risk way. But listen up, we're not talking about get-rich-quick schemes or chasing crazy returns. Nope, the name of the game here is protecting your hard-earned cash while still earning decent returns over time. So if that sounds like your cup of tea, grab a pen and get ready to take notes. 1. CPF Investment Scheme, CPFIS. The CPF Investment Scheme, CPFIS, allows you to invest a portion of your CPF Ordinary Account, OA, and Special Account, SA, savings into a range of approved products like stocks, bonds, unit trusts, and more. The idea behind CPFIS is to potentially earn higher returns than the default CPF interest rates of 2.5% for OA and 4% for SA, which can help grow your retirement savings faster. However, there are some important requirements to keep in mind. To participate in CPFIS, you need to be at least 18 years old and maintain minimum balances of $20,000 in your OA and $40,000 in your SA before you can invest those funds. Additionally, there are limits on how much you can invest based on your investable savings amount. For instance, you can only invest up to 35% of your investable savings in stocks and up to 10% in gold-related products. While CPFIS provides an opportunity to enhance your retirement savings, it's crucial to remember that all investments carry risks. Depending on market conditions, you could potentially lose some or even all of your invested capital. Therefore, it's essential to do your due diligence, understand the risks involved, and only invest what you can afford to lose. Investing through CPFIS should be approached with caution and a well-informed strategy. 2. Singapore Savings Bonds and AMP T-bills. Next up, we have Singapore Savings Bonds, or SSBs. These are special bonds fully backed by the Singapore government, making them an extremely safe investment option. SSBs have a 10-year maturity period, but the really cool part is that you can redeem them anytime before maturity without any penalty fees. And you still earn interest based on how long you held the bonds for. The interest rates increase each year in a step-up manner. As of June 2024, SSBs were paying an average return between 3.26% to 3.42% per year, depending on the number of years you held them. That's a pretty decent return for an absolutely risk-free investment. The best part is you can use cash, CPF, or SRS funds to purchase SSBs, making them highly accessible to individual investors. If you're looking for an even shorter-term option, consider Singapore Treasury bills or T-bills. These mature quickly either in 6 months or 1 year, and are issued at a discount to their face value. When the T-bills mature, you receive the full face value back. Currently, the yields are hovering around 3.65% for 6-month T-bills and 3.58% for 1-year T-bills. While the returns are slightly lower than SSBs, T-bills offer a convenient way to park your funds for a short period without taking on any risk. 3. Real Estate Investment Trusts, REITs. Real estate investment trusts, or REITs, are a popular investment vehicle that allows individuals to gain exposure to the real estate market without having to directly purchase and manage properties. REITs are companies that own and operate income-generating real estate assets such as shopping malls, office buildings, apartment complexes, hotels, and more. By investing in a REITs, you essentially become a shareholder and get to share in the rental income generated by the properties owned by the REITs. One of the key advantages of REITs is their requirement to distribute at least 90% of their taxable income to shareholders in the form of dividends each year. This legal obligation results in REITs often offering higher dividend yields compared to regular stocks, making them an attractive option for income-seeking investors. Additionally, real estate investments tend to be a good hedge against inflation, as property values and rents typically rise along with inflationary pressures. While REITs can provide a steady stream of income and diversification benefits, it's important to note that they can also be more volatile than bonds, and their distributions can be impacted if the underlying properties experience performance issues. However, when incorporated into a well-diversified portfolio, REITs can be an excellent way to generate passive income and gain exposure to the real estate market without the hassles of direct property ownership. It's crucial to conduct thorough research and due diligence when selecting REITs to ensure they align with your investment goals and risk tolerance. 4. Singapore ETFs. Exchange-traded funds, ETFs, are becoming increasingly popular investment vehicles in Singapore. These are funds that track specific market indices, such as the Straits Times Index or the S&P Wink with tongue sticking out 500. Unlike traditional mutual funds, ETF units can be bought and sold on the stock exchange during regular trading hours, just like regular shares. This trading flexibility is one of the key advantages of ETFs. One of the biggest draws of ETFs is their low cost compared to actively managed funds. Since ETFs are passively managed and designed to replicate the performance of an underlying index, they typically have lower expense ratios than actively managed funds, which can translate into higher returns over the long run. Additionally, ETFs provide instant diversification across a broad basket of securities within a single investment product. There is a wide range of ETFs available, covering different markets, sectors, asset classes, and investment strategies, allowing investors to tailor their portfolios according to their investment goals and risk preferences. While ETFs, being passive funds that track indices, are not designed to outperform the market, they offer a simple and cost-effective way to gain broad exposure to various asset classes and markets. Their low costs, diversification benefits, and trading flexibility make ETFs an attractive option for investors seeking to build a well-diversified core portfolio holding. As such, ETFs are definitely worth considering as part of an investment strategy, especially for long-term investors who prioritize simplicity and cost-effectiveness. 5. Robo Advisors. Robo Advisors have gained significant popularity in recent years, especially among younger investors who are looking for a convenient and cost-effective way to invest. These digital wealth platforms use algorithms to build and manage diversified investment portfolios tailored to your individual risk profile and financial goals. Some of the most popular robo-advisors in the market include StashAway, Safe, and Endowus. One of the key advantages of robo-advisors is their low fees compared to traditional human financial advisors. They typically charge a fraction of the fees that human advisors charge, making them an attractive option for those who are just starting out or have a smaller investment portfolio. Additionally, many robo-advisors have low or no minimum investment requirements, making it easier for individuals with limited funds to begin investing. The automated nature of robo-advisors is another significant advantage. You can monitor and adjust your portfolio anytime, anywhere, through a user-friendly mobile app or web platform. This level of convenience and accessibility is particularly appealing to younger investors who are accustomed to managing various aspects of their lives digitally. However, it's important to note that while robo-advisors offer a streamlined and efficient investment experience, you do sacrifice the personal touch and customized advice that a human financial advisor can provide. Robo-advisors typically use sophisticated algorithms to construct and manage your investment portfolio. They take into account your risk tolerance, investment horizon, and financial goals to create a diversified portfolio that aligns with your specific needs. As market conditions change, the algorithms automatically rebalance your portfolio to maintain the desired asset allocation and risk profile. This automated approach helps to remove emotional biases and ensures that your investments remain aligned with your long-term objectives. There you have it, Iguana's 5 stable investment picks to consider for your portfolio here in Singapore. From low-risk government bonds to diversified REITs and ETFs, there are options to suit different goals and risk appetites. The key is doing your homework, understanding what you're investing in, and never putting in more than you can afford to lose. Remember, steady and sustainable wins the race when it comes to building true wealth over decades. If you found this video helpful, go ahead and smash that like button. It really helps out the channel. And if you're not already part of the Iguana fam, hit subscribe and click that notification bell so you never miss an update. Drop a comment down below and let me know what other investing topics you'd like me to cover. I'm always looking for new video ideas to help you Iguanas get financially free. That's all I've got for now. Thanks for watching and see you next time on the Investing Iguana.